One of the things that people often tell me before they really embark upon trading either equity, fixed income, or just building a portfolio for their retirement is they pose one very, very simple question, which is, where do I start? Now that's a really sensible question, but it's not obvious where you do start. So what I want to do in this video is just give you a couple of thoughts, things you really need to consider before you actually start to trade. Now what I'm going to do here is focus more upon financial assets rather than assets like property, but the same applies to property as well. Now, the first piece of advice I usually give people is paper trade. In other words, before you actually start trading with real live equity, you write down on bits of paper, or nowadays you would write on spreadsheets, these are the trades that I'm putting on. And you have to log diligently exactly what you bought, exactly what you sold, and you have to treat it as though it were real trades. Then after a period of a month, 3 months, 6 months, you can assess your competence and you can see whether you've made money, and if you have made money, why you've made money, and if you haven't made money, why it's gone wrong. Maybe the market just sold off and you lost money because you were just in a sell-off. But at least that'll help you understand your own competence. Now it's possible you don't want to do that. You just want to dive right in and trade real live equity, and you feel like without the discipline of doing the real thing, it's not going to work. So either way, what I'm going to share with you in this video are two of the most important things you have to do, whether you're going to paper trade or whether you're actually going to trade the real live equity. Now I'll come on to those two things in a moment, but I just want to say we're here to help you. We have some professional courses which you can see online on our website. In the meantime, if you find these YouTube videos useful, do click subscribe, do click like, because it'll help other people to find these videos. So here's the question. What are the two things you've got to do before you first start trading? Now they both involve a spreadsheet. And the first one is you need to know what you own. You need to know what you buy. You need to know when you're selling it, and you've got to keep good records of this. So that's the first thing. What do I actually own in my portfolio? The second thing, which is equally important, is am I making any money or not? And therefore the purchase price, the sell price, the sort of real-time measurement of your portfolio performance is absolutely critical. That's what professionals do. You know, I've been in the market for the best part of 30 years, and I've advised institutional investors and I've managed my own portfolio. And the best investors, frankly all professional investors, they look at their returns on a consistent and rational basis, and you'll need to do the same thing too. So what we're going to do in this video is we're going to start to explore each of those two issues in some more detail. So the first issue being, what have I actually bought? And the second is, how much money am I making, or how much money am I losing? So let's get on with it. What have I actually bought? What's in my portfolio? Now, this might seem really obvious, because you can say, well, I've got one brokerage account. It shows me in the brokerage account what I've got. So I know that anyway. I don't need to keep this on spreadsheets. If you want to take that risk, it's up to you, but in my view, that does not work. Why does that not work? Well, firstly, you may have more than one brokerage account, and it's really difficult to integrate them unless you do it yourself on a spreadsheet. Secondly, the very discipline of doing this on a spreadsheet will focus your mind, and it will force you to think what it is you actually own and why you own it. And therefore, although it's kind of tedious to actually log what you own, I do think it's really important to do so on a spreadsheet. The third reason, which I think is actually the most important, is you need to understand how your portfolio will respond to different changes in market circumstances. So in order to understand that, you need to slice and dice it according to different criteria, and those criteria might change. Chances are the supplier of your brokerage account does not break your portfolio down in the way you need to see it. It's a standard method which is kind of designed for all sorts of investors, but it's not specific for you. So I really strongly advise you to break things down on a spreadsheet. Now, to give you an idea what I'm thinking, let's have a look at the 3-level process that I use to look at what it is that I own. So here's the first spreadsheet. This is for a synthetic investor, it's not me, and it gives you an idea of what it is he might own. Now, it's broken down, I'll call this level 1, at a very, very high level. So this is the total amount of equity he owns, the total amount of property he owns, the total amount of cash he's got in the bank, and also the total amount of fixed income assets, and by that I mean US Treasury bonds, gilts, corporate bonds, that he's got in his portfolio. Those percentages are really important because just at a high level you need to get a sense of how your assets are allocated. Now you might think, well, so what? The reason why that's really important is because one day you're going to panic that the market's about to drop 30%. The stock market can drop 30%, it does happen from time to time, and therefore you need to get a sense of how much money you're going to lose overnight. So keep that in mind, that there will be days when you're going to panic, you're going to feel bad, and you need to have the information systems to tell you what actions you might need to take. So it's useful to know if you've got 30% of your portfolio in equity. It's useful to know if you've only got 5%. Another reason that's absolutely key is that markets move. So if you start out with a certain percentage in cash, that isn't going to change very much, or certainly not at current interest rates. Whereas your equity portfolio can rally quite a lot, and therefore suddenly you might discover your equity allocation is going up, maybe a little higher than you thought it was going. Now, no broker is going to have this information because they don't know how much property you have outside your portfolio. They don't know what is sitting in your bank accounts. So it's good to have just a consolidated balance sheet that is telling you this is, in broad terms, what my household wealth is like. Now, it's sometimes tempting to start to split it out into different types of accounts and say this is how much is in my pension accounts, for example, if you're in the UK in your SIP, or for example in your 401k. This is in my bank accounts. I wouldn't necessarily go there for this. All I'm trying to recommend you do here is just look at it in terms of what movements in the markets will do to your portfolio. It doesn't matter so much where you hold it. That is a different question which needs to be addressed, but that's not the purpose of this video. So that's level 1. It tells you at a high level what it is you own. Let's now have a look at the same synthetic investor at his level 2 assets. So here we're going to drill down into his equity portfolio. I said I was going to focus on equity. This is what's sitting in his equity portfolio. Now here what I've done is I've broken it down into individual sectors. Why do you need to know what those individual sectors are? Well, for example, if interest rates are going up, you know that the interest rate sensitive sectors are going to be rather painful in your portfolio. Utilities, for example, may not perform very well. If you believe the economy is headed into recession, then clearly you want your portfolio to be biased more towards defensives like pharmaceuticals or utilities, in which case those you would expect to be performing rather better. So you really need to know how your portfolio is allocated within the equity market, and those percentages matter. Now, it's not as easy as you think, because if you're holding individual stocks, you can log each stock and it's the corresponding sector that matches with it. But if you're holding ETFs, that's not as straightforward. So if you've got, say, an ETF of the S&P 500, you need to note that part of that ETF is basically tech sector risk, part of it is pharmaceutical risk, part of it is going to be, for example, utility risk. So what I do is I actually break down the ETFs I own into their component sectors. Now, in general, I also own ETFs in different sectors, so I might own a tech ETF and then that gets lumped in the tech sector, a pharmaceutical ETF in the pharmaceutical sector. This enables me to see at any moment exactly what exposure I've got and to which sectors. Another level 2 asset allocation that is really important to monitor is your geographical asset allocation. So usually I might break this down into North America, Europe, Asia ex-Japan, Japan, and developed markets, for example. This is really, really important because the global economies are not perfectly in sync. And often you might discover that certain parts of the world are risky. So for example, in a downturn, often the developing markets get hit harder than the developed markets. So you need to make sure you've got an appropriate exposure there. You also might take a view that, for example, one economy, it might be performing particularly well, but this is all priced in the stock market. And if it's all priced in the stock market, then you've got to make sure that your asset allocation reflects that view. There's no point in holding views if they're not reflected in the asset allocation. So you want to break it down by different geographies as well. Again, that's relatively straightforward when you're holding individual stocks because you know which geography they come from. But there are two issues which can get in the way. The first is when you're holding ETFs, those will have a mixture of geographies possibly. They may not, you may just have, for example, French equities, but normally you'll have a mix of geographies. So you'll want to keep that logged as to how the ETFs you own are exposed, whether it's US, Japan, Europe, etc. The other problem with keeping geographies separated out is there are some companies, and there's a good chance this will apply to many of the companies you're going to buy, that they are spread across lots of geographies. In other words, they might be headquartered, for example, actually here's a really good example. Let's look at some of the energy companies. They're headquartered in the UK. But is this really UK risk as such? Often their shares are denominated in dollars, and what you might find is the larger part of their exposures are actually to overseas economies. So you may want to use your discretion and separate out some of those companies that you think are really global and really register them as such. Another example might say be the big 3 US automakers. Have a look at the proportion of their sales which is in the US and then take a view. Do they really count as just pure US risk or are they global risk? So you may want to have a separate category of companies which, although they're in a particular country in terms of where they report and where their stock is listed, they're really global risk. They're not specific risk to America or Japan or Europe. Clearly for smaller companies, often they're highly domestic, or what you find some of the utilities, for example, only operate in one jurisdiction. Now I appreciate this is probably a lot of work, but I do think it's worthwhile really understanding where your portfolio is allocated. If you've only got a few stocks, it's not going to be hugely challenging. If on the other hand you've got a very diversified portfolio of say 200 stocks across a number of ETFs, having that information to hand is really, really important, because when you see, and it'll happen, you'll see suddenly some economic data about a country comes out, the economic data is terrible, immediately you want to see how much exposure do I have to that country. Should I be unwinding it now? So that's really your level 2 allocations. The first is going to be by sector, and the second is going to be geographical. Now let's have a look at a level 3 allocation. So this is when you start to drill down further into the individual sectors. Now for a beginner, you may not want to go this far. It depends how much knowledge you have about the individual sectors. Certainly as you acquire knowledge over time, what you will decide is that there are certain themes or certain groups of companies within each sector, and you really want to get some understanding of how those individual groups work. So for example, in the tech sector, there's one subsector of that sector, which is the semiconductor manufacturers. And whilst they exhibit a lot of the traits of the entirety of the tech sector, it's also worth bearing in mind they are a separate subsector which trades differently to, say, some of the companies which prepare software, or for example the companies which provide consultancy services, some of which might sit within the tech sector. So you may decide you want to start to drill down further. Another example might be in the pharmaceutical sector, where companies which produce generic drugs and don't do their own research really might trade quite differently to those companies which are heavily research based and come up with their own new drugs and are therefore very vulnerable, for example, to the expiry of patents. This is the type of thing you're going to want to look out for, and therefore I would strongly advise, when you get the time, to start to categorise within each sector the types of holdings that you've got. So this is a sort of level 3 allocation. As I said, you may want to go there if you're a beginner. Another type of level 3 allocation you might want to consider as well is that certain groups of shares just trade differently because they do. So one of the areas that I always break out within the tech sector is the big names that we used to call the FANGs. I always break those out because I've noticed they trade differently to the rest of the tech sector. So I like to log that separately in my portfolio, because I know that sometimes that group of very large tech companies can become relatively large and relatively expensive relative to the rest of the sector. And it's something I may want to trade. Of course, monitoring it gives me another view on the market and sometimes an opportunity to make a bit of extra money as well. So in terms of your level 3 allocations, you need to think really what matters to you and also what's appropriate in the context of the current market environment. Now, so far I've just focused upon equity, but let's just look at what happens for an investor in some other asset classes. Let's say you're investing in property, for example. Then you might want to break down your property holdings into those you hold as real estate investment trusts and those you might hold either in your own name or in the name of a company where it's, say, buy-to-let properties or commercial real estate. You might own some shops. That's one way of doing it. And of course, another way is to actually delve down further and to split out your whole portfolio and say, this is my residential portfolio, some of which is REITs, some of which may be a buy-to-lets I own directly. Then this is my commercial portfolio, some of which is owned directly and some of which is REITs. And then start to delve down further into the various sectors of the REIT market. So if you're very heavily involved in REITs, for example, you might want to separate out farmland. There are a small number of farmland REITs out there, from data centres, from commercial properties like shopping malls, and you might want again to separate those out from other smaller commercial property that you might own. So again, it's a good thing to have this separated out, because once you've got it defined that way, and you can take a view on the market, you can see how your portfolio might respond if, for example, interest rates go up, and that's going to hurt certain sectors of the REIT market most. Another thing you might consider, and again, this is back on the theme of interest rates rising, is if you think interest rates are rising, have a look at all the REITs which are, for example, highly leveraged, and just note that may represent a sort of subsector in itself, and those will be especially vulnerable if rates go up. And of course, when you start to see rates coming down, clearly the most interest rate sensitive REITs are going to be the ones which are going to perform. So there are different ways in which you might want to slice and dice your portfolio, which are personal to you, and by just letting your broker do it, you're not really putting the work in. It's not really going to give you the information that you really need to see whether the views you hold in your portfolio are actually corresponding to the views you think the way the market should trade. So that's property. Let's now have a look at fixed income. So for your level 2 fixed income portfolio, you really want to have a good breakdown where you separate out sovereign credit risk, so for example government bonds, from those which are corporate credit. And then you'll want to drill down a bit further. So when you've got the sovereigns, you may want to separate out developed sovereigns from non-developed risk. Obviously you may not trade the non-developed sovereigns, I certainly don't. And then you might break it down further into your exposure on the yield curve. For the corporate credit, you may want to break it down into high yield versus investment grade, and then again your exposure to different sectors as you would in the equity market. Or you might want to break it down geographically as well. But that gives you a flavour of the kind of breakdowns you ought to have so that you can really understand how your portfolio is going to perform. Now the last section, which is really important, is to have a list of every single stock you own, every single asset you own, just by line item. And this will become really, really important later, because it does happen that a single stock can perform very well or very badly in a very short space of time, and you'll see your portfolio may not really reflect that, because sometimes swings and roundabouts, one stock's gone up a lot, one stock's gone down a lot, you just won't notice. If you can actually monitor the changes to individual stocks, this is really, really important. So I would actually have on a spreadsheet a list of every single thing you own. When you bought it, when you sold it, how the pricing has changed. This is absolutely critical. So why is it critical? Well, one of the reasons is concentration risk. You may not want to have too much in any one stock. You may feel as though that's not a good idea. I certainly like to avoid having too much risk in any one company, because if that company starts to underperform, it whacks the whole portfolio. So what I do try and log is everything I own and keep a watching eye on anything which suddenly gets to be too large a portion of my portfolio. Now straight away you're going to say, well, this is very challenging because ETFs themselves make up, for example, 300 different stocks, and therefore that's going to mean the number of line items you have is going to be enormous if you've got a lot of ETFs. Only you can decide whether the time you're going to spend on that, which admittedly is going to be quite large, is going to be worth it to you. You may decide that you'll just list the individual stocks you own directly and the individual ETFs you own, rather than try and drill down and expand every single ETF into the component stocks. And that's absolutely understandable. With any piece of work like this, you can get really locked up in the spreadsheets and try and produce more and more information for yourself. But as you produce more and more information for yourself, you've always got to watch, what is the cost of producing that information? Is it really worthwhile? 2, am I going to get just totally deluged or overwhelmed with information? so that I can't use it. And then lastly, you spend so much time playing on Excel that you sort of forget the main purpose you're there, which is to make money, and that producing management information systems is not a goal in itself. So when it comes to preparing your spreadsheets, always keep that in mind. There is a very important balance between producing more and more information, which is more and more valuable, and yet spending too much time doing that and not actually following the market. But do get that balance right. Do make sure you understand what you own, because unless you understand what you own, whether you make money is just then a matter of throwing the dice. It becomes a gamble. And also one important point, and I'm going to labour this one, you probably have a few views on the market which are really important to you. You must make sure your views on the market correspond to what's in your portfolio. If they don't correspond, you have to ask yourself, why not? Is it because the trading costs are so big that the cost of realigning your portfolio to reflect your views is simply not worth it? Or because you're simply mismanaging your portfolio? You're not making sure that the views you have are reflective, because there's no point in getting all your views right and making no money. So that's one of the reasons I really stress, understand what it is you own. Now, I said at the beginning of this video that I will be covering some of the issues that you ought to understand to try and measure the performance of your portfolio. And that's what I'm going to move on to now. Now here I'm just focusing upon what I consider to be the bare minimum requirements for data you need to keep. So please don't take this section as being a comprehensive analysis of how you might measure the performance of your portfolio. It's not. All this is the very least I think you should do in terms of data collection to assess your competence and to figure out whether you're making money or not. So there's just 4 spreadsheets that I'm going to show you on this occasion. And what we'll do is on another video, I'll then go into lots more detail. And of course, if you look at our online course, there's also more detail, vastly more detail, in fact, in terms of the information, the data that you should be keeping. But here for now is the bare minimum. So we discussed earlier that we needed to keep the line items of every single position that we have. Now, what I mean by that is something on this Excel spreadsheet that you can see here, where we log the purchase price, the sale price if the position has been sold, and of course we keep the current price as well. It's easy to get hold of the current price. Either you can see it from your broker, or there are functions on spreadsheets which will download automatically the current price of a large number of stocks and ETFs. You don't need to put it in manually. That isn't necessary anymore. This is a simplified spreadsheet, this one. So the only 2 stocks that I've used are denominated in dollars for a dollar investor. So there's no FX here. What I particularly want to draw your attention to is that at some particular time interval, and in this case I've chosen 1 month, historize your data. So what I'm looking at in terms of the rows is the value of each stock, the purchase price and the current price, and then I'm grabbing that current price and I'm keeping it for different dates in history. And there's 3 dates in history that I'm showing you there. This is absolutely critical because then at a later point in time, you can go back and see this is how each trade I put on, each stock I've purchased has performed. It's also great because when you unwind the position, you can put in the sale price and then you can work out your capital gains tax liabilities if you're in a jurisdiction which charges you capital gains tax on your profits. Also, it's a good way if you're losing money as well. You can use those to offset some of your profits. Good way to log them as well. So this is a very, very simple spreadsheet to keep. In this case, for just 2 line items. And I strongly recommend that this is the minimal amount of data. Now you'll see that I historize the data every month. Maybe you should use this, you do every day, maybe it should be every week, maybe every month, every quarter. Only you know how much time you have to start updating spreadsheets. The danger of doing it every day is you get overly focused upon day-to-day performance, which I think is not a good idea. If on the other hand you do it every quarter or every year, then I think clearly you're not really in the market, you're not focusing sufficiently. So you need to find a balance in terms of your time and what you're trying to achieve in your portfolio. In this particular case, I've done it every month, but there's no harm in doing it more frequently. One thing you should consider here is the old adage, you get what you measure. In other words, if you measure your performance frequently, you're going to get better performance, in my view, than if you decide you'll just look at it once a year and see whether you've done well or not. So I do think by putting yourself under that spotlight, putting yourself under the scrutiny, it leads you to focus on why you're making and losing money, and that in turn leads to better outcomes for your portfolio. So in the first spreadsheet, this was very much a special case. A US investor who's got dollars to invest, who's buying US equity. There's no currency here. Now we've relaxed one of those assumptions, and the US investor has now gone ahead and bought a UK equity, which is denominated in sterling. How do we account for that? So I think in terms of purchase and sale, always log the value of what you purchased, both in its local currency and also in your base currency, in other words, in dollars. So you'll need to know both. The reason why that's really important is when you're assessing whether those trades made sense or not, your return is made up of 2 elements. One is the currency, and one is the stock price movements. You might have been a brilliant stock picker, but if you happen to have bought sterling stocks, and let's say sterling's gone down and down, you may have made no money out of it. Not a great position, but it always helps to know why, because it's an important lesson. You're going to have to manage both, and therefore keep an eye on the currency and on the original stock price. So for purchases and sales, log both. When it comes to reporting your performance every quarter or every month or every week, as you might choose to do, obviously it's highly desirable to log both, but just to simplify matters, what I've done on this spreadsheet is I'm just keeping everything in dollars. In other words, every sterling stock that I own, I translate the price back into dollars and I log it every month, in this case, in dollars. If I was buying stocks in Europe and they were denominated in euro or in Swiss franc, again, the same thing, I would translate them back into dollars because I am a dollar-based investor. Much easier to then add up the size of your portfolio and see what the total returns are, and much easier to measure your aggregate performance, because ultimately it's the aggregate performance of both currency and stock picking which really matters. So in my case, as I rank my performance in dollars, that's the way I do it. So every month I will log the value of every position translated back into dollar terms. One tip here, you'll see that for every number I've been very clear which currency it's denominated in, dollars or sterling, because in a year's time or 2 years' time when you go back to look at this, you'll be totally confused if you haven't been very explicit about the currency that you're referring to. So make sure you've got that down very clearly on the spreadsheet. Now I mentioned that by having everything in dollars, I can add it up really easily, and therefore I can log for this component of my portfolio how much money I've made. This might be, for example, the tech sector, or it might be pharmaceuticals. So I can see how much money I'm sitting on in each of those sectors, and I will log that, in this case, every month. This is the minimal requirement. I must re-emphasize that to say you've made that return every month could be slightly misleading, because if you're trading, money's coming into or going out of the sector. But at least it gives you a sense for each trade of how much money you're making, and most importantly, you're keeping all the data you need to keep. So if we want to draw more embellishments onto our performance, we really want to drill down and understand how much money we're making and when, we can always do that by building more spreadsheets on top of this one. But at least we've captured the raw data, and that's what really matters. Now here you can see the highest level performance, where I've logged the value of the total portfolio, including fixed income, property, every part of my portfolio. And again, I've gone to the effort of capturing it month after month after month, so I can look back and see how much money I'm making. Over time, you may want to put some adjustments into that, but if you're putting more money into the market, putting more money in doesn't really mean better performance. So you'll want to adjust for additional cash you're putting in the market. But you can see at a very basic level, this is giving you some core information about the levels of your own competence and whereabouts you're making the money. And this is the simplest way, without spending too much time on building complicated spreadsheets, to just historize how you're doing, what you own, and where the money is being made. We're going to revisit this whole performance issue in much more detail in further videos to come, but for the time being, I think that's the basic amount you need to know. Any questions, of course, put them in the comments, and I'll come back to you with what I think are some really helpful answers. In the meantime, I hope you found this video helpful. Do please click like if you have found it helpful. Do please click subscribe. There will be more videos coming along soon, and in particular, we'll be looking more at some of the spreadsheets you need to really make sure that you can measure your performance and you can see what is the best way to trade this equity market, to trade the property market, and to trade fixed income. Whatever it is you're buying, we'll cover how you can log that information.